Good morning, students. Welcome you all once again today. And today we are going to discuss the second and the last class on Ind AS 1 presentation of financial statement. So friends, in the last class, we have discussed the agenda of the standard. The standard talks about the objective and scope, that why the standard is, what is the purpose of the financial statement, what are the component of the financial statement. One of the important point this standard takes care of. Definitions, few definition you remember. We have discussed the definition of general purpose financial statement, definition of Indian accounting standard, definition of materiality, right? And this standard also talks about the overall considerations, that key features, what should be the key features, okay? And this standard also talks about the structure and content of the component of the financial statement, right? Then we discussed what is the objective of this standard. Then we discussed what is the scope of this standard, right? We discussed some definitions. We discussed the purpose of the financial statement. Then we have discussed the component of the financial statement, and there we discussed that there is a balance sheet, right? And Ind AS balance sheet starts from the asset side, then equity, then liability, okay? Then there is a statement of profit and loss, like in our IGAP, but this statement of profit and loss is much extended and bigger in comparison to the old statement of profit and loss. Why? It includes a separate section of other comprehensive income. I have shown you one of the annual report, right? Statement of changes in equity. This is again a new component, a separate component. Why? This present your movement in equity share capital and reserves and surplus. Then there is a cash flow statement, which is statement of cash flows. Then there are notes, which includes accounting policies, basis of preparation, right? Accounting policies, then explanatory notes like breakup of the balance sheet, or I would say schedule of the balance sheet, schedule of the P&L, and other quantitative and qualitative disclosures like related party disclosures, contingent liability disclosure, capital commitment disclosures, segment reporting disclosure, actuarial related disclosures. Okay. Then, of course, there is a comparative information in the entire set of financial statement. At least 1 year comparative is required to be given. And friends, one of the important section from where you can have the, questions as well. And one of the important section was the opening balance sheet. Which opening balance sheet? The opening balance sheet of the comparative period. And I call it as a third balance sheet. A third balance sheet is required to be prepared, which is opening date of the comparative year in 3 circumstances. What are these 3 circumstances? When the company is correcting the error retrospectively, right? So if the company has made any error, this has to be corrected retrospectively. Of course, the error should be material, right? If the company is a big $1 billion company, thousands of crores is the size of the company, and there is an error of hardly 50 lakh rupees. It is not a material amount, and hence no restatement is required in the last year, and no third balance sheet is required there. So if the impact is material and there was an error in the past period, so of course comparative number needs to be restated, and opening of the comparative balance sheet needs to be prepared. And why I'm saying balance sheet needs to be prepared? So that the opening number needs to be corrected. And I have shown you one of the case study in the Excel file, right? And I have shown you the real life example from ONGC Limited annual report. You remember that para number 54? Okay. What is the second circumstances? When the company changing any accounting policy, right? So again, the impact has to be given retrospectively. Third, when the company is reclassifying the items in the financial statement. For example, earlier the company has shown something in sundry debtors. Now the company wants to net it off with the creditors. So this number which the company has shown in the past, now the company wants to reclassify this number from debtor to creditor, right? So probably in this case, again, comparative needs to be restated and third balance sheet needs to be prepared. Friends, in our Indian GAAP, the life was pretty simple. If the management or the auditor found any error, so the correction needs to be made in that year only in which the error got detected. What does it mean? For example, in the current financial statement, let's say for 22-23, the management or auditor has found an error pertaining to financial year 16-17. So in this case, the impact of the error needs to be calculated as on date, and that number has to be shown as a separate line item as a prior period item. Number has to be, given in the current year only, and that's how this error needs to be corrected. Okay. But in Ind AS, and if you have already covered Ind AS 8 or you are going to cover Ind AS 8, you will realize that, same thing is there in Ind AS 8 also in this area. So in Ind AS, what they are doing, if there is an error, so first they need to compute the impact of the error from the date of the error to the opening of the comparative period, right? So whatever cumulative impact is there, that needs to be adjusted with the opening balance sheet of the comparative period. If opening balances are correct, then previous year number needs to be restated. And of course, current year numbers are under preparation, so they will be corrected. Okay. So this is how this thing has to happen. And this is a very important concept. This is a new concept. And fortunately, this concept is repeated in the standard for 2 times. One is in Ind AS 1 and the another one is in Ind AS 8. Same thing you will read in Ind AS 8 also, right? Is that clear? Yeah. So I can see a lot of active participation from the students. So Mansa, Vanshika, Deepak, Viraj, Gazar, Vanshika, Rajiv. So good morning, everyone. So Vanshika, I have shared the notes. Probably these will be uploaded today itself, because today we are completing this Ind AS 1, right? So I'll do a lot of things on Excel file. So you will get a consolidated Excel file today. Rajiv is asking, can we do restate in books of accounts in opening of the comparative period 1st April 19 when we are in FY 2021? So Rajiv, that's what I told you. If you are in FY 2021, your comparative is FY 1920, right? So you are not going back in time, means the last filed financial statement does not needs to be revised. Understood? The current financial statement in which you are putting your comparative, those needs to be restated. Okay. Only in the current financial statement. Is that clear? And that's how I have shown you the ONGC example. ONGC Limited annual report for financial year 1920. I have shown you, right? Even though if you have not seen that, so either you can refer the video or you can download the ONGC annual report and you can see that. Okay, let's move on, guys. So this is what we have discussed in the last class. Now we are going to, now we well understood the component of the financial statement. Now we are going to discuss the general features or overall consideration, right? For example, what is meant by general features or overall consideration? For example, you are the student of a school, right? So management says that if you are a student, there are some minimum requirement. What is the minimum requirement? You have to be, on time. You have to reach school by 8. You have to go to the assembly hall. You should wear the school uniform. Your uniform should be neat and clean, right? You have to maintain the decorum in the class. You should not carry your mobile phone. So what is these things? These are the general features. These are the general requirement. These are the considerations which you need to consider while preparing your financial statement. Okay. Like these kind of discipline which you need to maintain while preparation of the financial statement. So this standard is such a meticulous standard that this standard has given these kind of discipline as well, these kind of requirements as well. Understood? What are these kind of requirement? Presentation of true and fair view and compliance with Ind AS. Friends, in our IGAP, I mean to say accounting standard days, it is the auditor who says that the financial statement of XYZ Limited has been prepared in accordance with accounting standard notified under section 133 of Companies Act 2013, and these financial statements are reflecting true and fair view. So auditor is writing this in the auditor's report, right? Management was not obligated to write that. But now, friends, management, I mean to say the company which is preparing the financial statement, they are obligated to write this statement in the notes to accounts, right? And what is the statement they are obligated to write? The statement which they are obligated to write is, the company has complied with all Indian accounting standard, and these since there is a rebuttable presumption. So first of all, how you will say that your financial statement are presenting true and fair view, right? And the same example, if I again relate with your school days, how someone will say that you are a good student? How someone will say that? If you are attentive, you are on time, right? And you attend all the classes, your attendance is good. So then there is a rebuttable presumption. If the student is maintaining all the decorum and discipline, the student is scoring good marks, I can say that that student is a good student. Likewise, how can you say that your financial statement are reflecting true and fair view? So in Ind AS 1, it says that if you are complying with the requirement of all Indian accounting standard, in that case, there is a rebuttable presumption that your financial statement are reflecting true and fair view. There is a rebuttable presumption that your financial statement are reflecting true and fair view. I hope that is okay. Yeah. So let's discuss more on this. Friends, presentation of true and fair view and compliance with Ind AS, right? So as I told you, the true and fair view assumed through application of all Ind AS. And friends, there is a para 16. Please write down para 16. There is a para number 16. Sir, do we need to remember this paragraph? Answer is no. Right? You are not required to write the para number, but I am telling you this para 16. Why I am telling this para 16? Because this para 16 is very important and relevant, right? Friends, this para 16 of Ind AS 1 says that the management has to give explicit and unreserved statement of compliance of all Ind AS. First of all, explicit, right? Second, unreserved statement of compliance. So number one, in Ind AS, there is a new requirement. What is the new requirement? The new requirement to present statement of compliance. As I told you, in IGAP, this requirement was not there, but in Ind AS, this requirement is there. So management, while preparing the financial statement, has to write the statement of compliance. Before accounting policy, the management has to write statement of compliance in the notes to accounts, right? So this is the requirement in Indian accounting standards. Sir, which kind of statement of compliance? So the management has to write explicit. Explicit means clear. And unreserved. You understand the meaning of unreserved? Means no qualification is there. You cannot say that we have complied with all the requirement of Indian accounting standard except Ind AS 19, which is on employee benefits. Why? Because we don't find any actuary. Can you say that? Answer is so. Ind AS 1 says that you have to give the explicit means clear cut and unreserved means unqualified statement of compliance of all Ind AS, right? Let me show you the practical example out of it. What is that statement of compliance? Friends, I hope you are able to see this screen of Tata Consultancy Services Limited. I hope you are able to see this Tata Consultancy screen. You can see this. An extract from the annual report of Tata Consultancy Limited for the year ended 31st March 22. You can see that. So they have given the statement of compliance in their notes to accounts after basis of preparation. These standalone financial statements have been prepared in accordance with the Indian accounting standard as prescribed under Section 133 of Companies Act, read with the company's Ind AS rules as amended from time to time. You can see that there is a very clear, no qualification is there, very clear and unreserved statement of compliance. They have simple write that these financial statements have been prepared in accordance with all the requirement of Indian accounting standard as given under Section 133 of the Companies Act 2013, read with the company's Ind AS rules as amended from time to time. Am I right? Am I right, friends? Very clear requirement. Yeah? Is that clear? Let's move on. So now you understand that there is a requirement of statement of compliance. So let me go back to my presentation. So friends, standard says that can is there any circumstance where you can depart from compliance of Ind AS? Means if Ind AS compliance says X, you should not do the compliance. You can depart from the compliance. So standard says that in extremely rare circumstances, right? It says that in extremely rare circumstances where compliance with a standard would be misleading, so it would conflict the objective set out in the framework. Which framework? You guys have already covered the class of conceptual framework for financial reporting. So it says that normally the Ind AS are prepared in such a manner that it will not conflict the objective set out in the framework. But you feels that compliance with the Indian accounting standard may conflict the confidentiality. For example, when you read Ind AS 108, Ind AS 108 is a standard which talks about operating segments, right? Segment reporting. There is a requirement in that standard that you have to disclose the major revenue, means revenue for more than 10%, coming from the customer. The name of the customer you are required to disclose, or you are required to disclose those customer who is contributing more than 10% of revenue to your business. So friends, let's say the company is in such a kind of a sector or industry. If the company would disclose the name of the customer, there is a risk that the competitors would approach that customer, and this may impact the business of that entity. So if entity feels that giving a name of the customer, right, who is contributing more than 10% of the revenue, it will also, it will also impact the business. It will impact the confidentiality with the customer, because there is a confidentiality clause signed with the customer that the company will not take the name of that customer in the public forum, right? So probably in this case, although it is a requirement of Ind AS 108, but the company may mislead this requirement, and the company may go ahead with not to disclose this disclosure in the notes to accounts. So this is permissible, but this is only permissible if the regulatory framework requires or does not prohibit. Means if the regulation says that, for example, regulatory framework means SEBI compliances, Companies Act compliances, or for bank RBI compliances, or for insurance company IRDA compliances, right? So if these permits that, okay, or any other law permits that, okay, this is good not to disclose, right? In that case, you can avoid the disclosure requirement, but a specific disclosure are required in that case. Sir, what kind of specific disclosure? A specific disclosure is required that you are deviating with which standard, right? And which kind of requirement you are not disclosing. For example, you will say that the requirement relating to the major customers has not been disclosed due to the confidentiality agreement signed with the customers. Okay, is that clear? Is that clear? Shruti is saying, sir, but if the company is not following any Ind AS, still also we have to write unreserved. And if auditor qualify the report, Shruti, if the company is not following any Ind AS, in that case, the company cannot write this explicit and unreserved statement of compliance. What happens if the company writes such explicit and unreserved statement of compliance? Of course, auditor has a tool to qualify that audit report, right? And auditor can write that the company is not following the requirement of Ind AS, right? The auditor can write that. And those financial statements should not be considered as a Ind AS compliant financial statement. Okay. Is that clear? Now, friends, so we understood that there is one requirement, presentation of true and fair in compliance with Ind AS. The second one is going concern. it says that your financial statement should be prepared on a going concern basis. What is meant by going concern? Going concern means business will run forever in the foreseeable future. Sitting on the reporting date means 31st March. Sitting on the reporting date, management is saying that my business is good to run in the foreseeable future. What is meant by foreseeable future? Foreseeable future means 12 months from the reporting date. Please write down. Foreseeable future means 12 months from the reporting date. When preparing the financial statement, management shall make an assessment of an entity's ability to continue as a going concern. Management shall make an assessment of an entity's ability to continue as a going concern. Ability to continue as a going concern in future, but for what period? How can you say that sitting today that my business will be able to run for the next 15 years, next 20 years with a confidence? You cannot say that, right? For example, people were not aware about COVID. So even the good business have failed in COVID, right? So friends, that is why standard says that since every year you will prepare your financial statement, every year you will do the reporting. So at least from this year to the next reporting year, I'm not talking about interim financial. From this year to the next reporting year, at least you should have a visibility that you will perform as a going concern entity. You are able to continue this business in the next 1 year, right? So that is why it talks about foreseeable future. And when it talks about foreseeable future, it talks about 12 months. Okay. It talks about 12 months. I hope that is clear. So friends, first of all, this is a fundamental accounting assumption that the financial statement needs to be prepared on a going concern basis, right? It has to be prepared on a going concern basis, right? An entity shall prepare financial statement on a going concern basis unless it says that normally it's a normal thing, right? So you are not required to say that, yes, my financial statement is prepared on a going concern basis. But if you are not preparing on a going concern basis, then disclosure is required. If you are going school on time, you are not required to disclose it. But if you are taking a leave, you are going late, then you are required to disclose it to your class teacher or your principal or your teacher that, madam, I am late today due to so and so reason. Like in office, if you are going to office, do you need to disclose to everyone? But the day when you are not going to office, you are disclosing it categorically to your principal. Am I right? That, sir, I'll not come to office tomorrow. Why? Because there is a marriage of my brother, right? And I have to attend that marriage of my cousin. Okay? So if you are following going concern, no disclosure is required. But if you are not following going concern, then disclosures are required. So now it says that an entity shall prepare the financial statement on a going concern basis unless these two circumstances happens. Number one, there is an intention to liquidate or to cease trading, right? The company's intention, the company's business is going very well, but the company does not want to operate in the China's market, or the company does not want to operate in that particular business, right? So in that case, there is an intention to liquidate or to cease trading, right? Or no other alternative except to do so, right? Friends, if the company has an intention to liquidate, of course, you will not prepare on a going concern basis. If the company's intention is to stop the trading, again, you will not prepare your accounts on a going concern basis. Or your intention is not to liquidate. Your intention is to run the business. Your intention is to continue the trading, but you don't have any option except to shut down the business. Sir, what could be the scenario? For example, the company is into the plastic manufacturing business, right? And this is the only product line of the company. Now government on 31st March, the company is preparing the financial statement. The company's board meeting is scheduled on 15th May, right? So in the month of April, there is an announcement which came from the government, and government says that we are we are banning the trading of plastic items in India, let's say. So government has banned that, and government has given only a time period of 6 months, that effective from 1st October, this plastic manufacturing and trading will be banned in India. I'm just giving you an example. So friends, sitting on 31st March, so the financial statement will be approved in 15th of May. So in between, there was an announcement which has a major impact or severe impact on the business. And of course, after 6 months, the business will not able to continue to run as a going concern. In that case, the company does not want to shut down the business. The company does not want to stop the trading, but company does not have any option except to shut down the business due to the government announcement. So in that case, again, the company should not prepare the financial statement on a going concern basis, right? Disclose in case of material uncertainty. For example, the going concern is not doubtful, but it is uncertain. For example, there is a major court case which is going on. If I correctly tell you, there is a company. If the recent example with which I can tell you, there is a company known as Delta Corporation Limited. This is into the casino gaming company. It's a very international level of a company, international level company, and this is a listed company, Delta Corp. Right? You can write and you can see on Google also. 2-3 days back, government has issued a notice of demand for 17,000 crore of GST liability. 17,000 crore. The net worth of the company is close to 5,000 crore, right? So company's net worth is 5,000 crore, but they have a demand of 17,000 crore, which they have contested, right? Or they are in the process of contesting. Friends, in this case, if this demand will be finalized, of course, they will go to the High Court, they will go to the Supreme Court. Looking into this severity of the demand, they will reach to the highest level, I'm sure. But friends, don't you think the moment the government has issued a notice of demand, it creates a material uncertainty to the on the going concern of the entity? If this demand will be materialized, the company's business will finished. The company will be finished. So of course, if talking about today, if this demand would not have come, there was no issue in the running of the business. But when this demand has come and the company is also protesting, the demand can be frivolous demand. So there is a material uncertainty which has been arised, right? So in this case, the company is required to disclose that there is a material uncertainty relating to the going concern. Why? Because the government has issued a notice of demand of this and this amount, and had this demand materialized, the company will not be able to continue as a going concern, right? So this is a material uncertainty. Okay. So this is a real life example I have told you just 2-3 days back. If you want to see the material uncertainty relating to going concern note, there is a company called as Vodafone Idea Limited. You can download the annual report of Vodafone Idea Limited and you can see they are giving the material uncertainty relating to going concern note in every quarter, in every year, right? Why? The company is continuously into losses. There is a huge demand by the Department of Telecom for AGR, right? And that is why the company is giving material uncertainty relating to going concern note, and they are saying that our life is depending on the negotiations which we are doing with the creditors, right? The funds which we are going to arrange from the lenders, okay? And the money which we are expecting from the promoters. So they are saying that although we are running our business, we are living our business, but our life is depending on so and so conditions, right? So this is how this material uncertainty relating to going concern note is required to be given in the notice of accounts. If financial statements are not prepared on a going concern basis, then disclose the fact that the financial statements have not been prepared on a going concern basis, and why the financial statement has not been prepared on a going concern basis. This is also required to be disclosed. Mansha is asking, sir, Vodafone annual report of which year? Vodafone annual report of even current year, last year. So any annual report you can download for either financial year 2021, 21, 22, 22, 22, 23, right? Whatever. So in every year there is a note. I hope it is clear. So we discussed the two features, friends, presentation of true and fair view and going concern. The third one is accrual basis. Very simple. Do I need to discuss this accrual basis? The all the component of the financial statement except cash flow statement needs to be prepared on an accrual basis. Accrual basis means, for example, in the month of March, the company has made a credit sales of rupees 1000 crores. Credit sales of rupees 1000 crores. And the money has been received in the month of April. So friends, whether this 1000 crore revenue has to be taken in that financial year only, answer is yes. Why? Because the financial statement has been prepared on an accrual basis. It is requirement of Ind AS as well as Companies Act that the companies will prepare the financial statement on accrual basis. Accrual basis means recording the transaction in the period in which it got incurred. So you have to pass an accounting entry, debtors account debit to revenue account, right? So this 1000 crore will come in the financial year in which the company has made a sales. In the next year, when the money will come, you will pass an accounting entry, cash account debit to debtors account, right? So in the next year, only debtor will be converted into cash. That's all. Understood? This is the meaning of accrual basis. All the component of the financial statement has to be prepared on an accrual basis except your cash flow statement. Cash flow statement is like a cash. Okay. Aggregation and materiality. What is meant by aggregation and materiality? Right? So friends, let me talk about materiality and aggregation. So first of all, the financial statement which you are preparing, these financial statement are for the full year. Of course, yes, for the full year, right? Let me talk about Reliance Industries Limited. They have a turnover of, let's say, 10 lakh crores. Let's say turnover of 10 lakh crore. Okay. So friends, if the company which is of such a size and the company has a million and billion of transaction during the year, and you know the balance sheet. Have you seen the balance sheet of LIC? LIC of India. LIC is also listed company. Their balance sheet size is close to 50 lakh crores. 50 lakh crores. So this 50 lakh crore balance sheet size, 50 lakh crore of balance sheet size. You know what is the size of the, how this balance sheet look like and in how much pages this balance sheet is covered? In 2 pages. See, 50 lakh crore balance sheet has been presented in 2 pages. And if someone will ask how many transactions are there behind this 50 lakh crore, there are millions and billions of transactions in the last 365 days. Yeah. For example, there are 1 crore policy holders. So 1 crore persons has paid the premium. 1 crore transaction. So friends, if the concept of materiality and aggregation would not have been there, do you think it is easy to prepare and present the financials? It is easy to present and prepare the financial. Is it easy? Tell me. Tell me, friends. Is that easy or not easy? What do you say? It is not easy to prepare the financial statement. And why? Because it is not easy. Because what you will present if you have a 1 crore transaction for sales, how do you present that? So standard says that all like item needs to be aggregated. All like items. So you can see that there is a revenue from operations of, let's say, 5 lakh crore of revenue from operations. So this is how this all the line item has to be aggregated, right? Understood? all the like item needs to be aggregated. Property, plant and equipment, 11 lakh crore. This property, plant and equipment is one line item, means all the like item has been aggregated and shown as a single item. So what is materiality and aggregation standard says that all the material item needs to be presented separately and all the like item needs to be aggregated, or all the immaterial item needs to be aggregated. For example, other current asset, other non-current asset, other current asset, other non-current asset. What does it mean? It includes so many small items, other expenses. So these are the immaterial item which has been aggregated and shown as a separate category others. Okay. But if I talk about like your revenue, like your finance cost, these are the material items. So this has to be presented separately. Understood? This is the concept of materiality and aggregation. Right? Now, Mr. Shankara is saying, sir, in study material, there is a line on going concern, like an example of 18 months. Can you please explain it, sir? So, friends, let me show you the study material where Mr. Shankara is saying. So, I hope this study material, you can see this study material. In study material, it says that the 12-month period for considering the entity's future is a minimum requirement, right? It's a minimum requirement. You should at least expect that the business will run for at least 12 months, right? Minimum. An entity cannot, for example, prepare its financial statement on going concern basis if it intends to cease operations 18 months from the end of the reporting date. What does it say that? Friends, let's say you are preparing you, and I am just asking you from the common sense. You are preparing your financial statement, right? While preparing the financial statement, you have to see the going concern situation, that you have to prepare your financial statement on a going concern basis. Okay. So now, when you are preparing the financial statement on 31st March 2023, okay. So you have decided that you will shut down your business on 1st October 2024, right? That is after 18 months. Sitting today, you have decided that. Okay. So what study material says that if today you have already decided that after 1.5 years you will shut down your business, okay, in that case, will you still show your financial statement of business as a going concern entity? Answer is no. It says that since that by the time you are preparing your financial statement, you have decided that you will shut down your business in the next 1 or 1.5 years. It means you are not required to prepare your accounts on a going concern basis, so that the stakeholder will be able to understand that you are going to shut down your business in the near future, which is close to the 2 years, within 2 years. So what it says that assessment of a going concern requirement, this 12-month period is the minimum period, right? You cannot say that I have the only visibility for the next 6 months, not for the next 12 months. So at least you should have the visibility of the next 12 months. But if you have the complete visibility of next 18 months that you are going to shut down your business, then what you will do? Of course, you will not prepare your accounts on a going concern basis. Sir, what happens if sitting today I'll say that after 5 years I'll shut down my business? Friends, you cannot go ultra long term, right? In that case, you are only required to just put a disclosure that due to the binding agreement or due to the binding requirement, okay, the company will shut down the business by 31st March 2028 or on 31st March 2028, right? So in that case, only disclosure is required. You cannot say that every year the company will not prepare its accounts on a going concern basis. You cannot say that, right? So you have to just take the judgment in that case. Is that clear? Is that clear, Shankara? Shankara, is that clear? Or it is not clear? Okay, let's move on, guys. Metallurgy and aggregation we discussed. Then the next one is offsetting, right? What is meant by offsetting? Offsetting means setting off. What is meant by offsetting? Offsetting means asset liabilities, income and expense shall not be offset unless required or permitted by Ind AS. Or I can say that asset and liability can be offsetted, income and expense can be offsetted if it is permitted by Indian accounting standard. I'll give some example. For example, on few items the company has a deferred tax asset. On few items the company has a deferred tax liability. So will the company present both on the face of the balance sheet, DTA as well as DTL? Will the company present both on the face of the balance sheet? What do you say? Whether the company will present both on the face of the balance sheet? Answer is no. The company will not present both on the face of the balance sheet. The company will offset DTA and DTL and net it off. Offset means net it off, right? For example, if DTA is 100 rupees and DTL is 40 rupees, the company will present net 60 rupees as a deferred tax asset. Vice versa, if the company has 100 rupees of deferred tax liability and 60 or let's say 40 rupees of deferred tax asset, so net the company will present a deferred tax liability of 60 rupees, right? Or 40 rupees, whatever it may be. Why? Because it is permitted by Ind AS 12. The second example, Ind AS 115. So this was the example from balance sheet. Now let's take an example of P&L. Ind AS 115, revenue from contract with the customer. It says that revenue from contract with the customer says that if a company is making a sales and the company is earning a revenue of let's say 1000 rupees and the company is giving a discount of 10% to the extent of 100 rupees, right? So whether this discount has to be shown as an expenses or the gross revenue has to be shown as a revenue, answer is no. 115 is Ind AS 115 says that the revenue has to be netted off with the discount. This is known as the offsetting. So friends, in the balance sheet, in the P&L, offsetting is required, netting off is required between assets and liabilities, between income and expense if it is permitted by Indian accounting standard, right? Is that clear? Is that clear? Yeah. I hope it is clear. Mansa is saying, in short, we can be visionary for a better things. In such cases, we can predict future for ultra period, say 5 years. Mansa, normally for assessment of going concern, normally companies are assessing the continuity for next 12 months. That is the prime rule, right? Minimum 12 months. Now, if the company has a reverse visibility, right, that the company is not able to continue in the next 18 months, in that case, you are not required to comply your accounts on a going concern basis. You are not required to prepare your accounts on a going concern basis. This is that way. Okay. Now I have taken another example, sir. What happens if I have the visibility today, but my business is not going to shut down in the next 1 year, but my business is going to shut down in the next 2 years, or my business is going to shut down in the next 5 years. In that case, my dear friends, will you today prepare your accounts on a non-going concern basis? Answer is because this 5 year is a very long period, right? But this 18 months, 17 months is not a long period that way. Okay. So you need to take a judgment for that, because today you are clear that after 18 months, you're not going to live. Is that clear? Yes, Ruti, you're right. All other Ind AS are also applicable. You're right. So now let's move further. So we talked about aggregation and neutrality. We talked about offsetting. Now let's talk about frequency of reporting, comparative information, and consistency of presentation. So friends, Ind AS says that consistency. It says that presentation and classification should be retained unless change in nature of operation necessitates other presentation or a standard or an interpretation require a change. Friends, Ind AS 1 says that your accounting policy, your presentation in the financial statement, your classification should be retained, should be consistently maintained from one period to another. From one period to another. Okay. Why it is important? Because if today you have classified some expenses in other expenses, tomorrow you will regroup that expense in some different kind of expenses, your number will not be comparable. So Ind AS 1 says that your presentation, your classification, your accounting policy should be retained and maintained until and unless your business activity and process has got changed. In that case, you are allowed to make a change, or the standard requires to change. Standard has got amended. In that case, of course, you are required to change. Otherwise, you should not change your classification, your presentation, your accounting policies, right? Comparative information, you all are aware. At least 1 year comparative is required. In comparative, not only in balance sheet and P&L and cash flow or statement of changes in equity, the comparative is required into the notes to accounts as well, right? And in comparative to information, which is quantitative and qualitative, both the information are required to be given. So not only quantitative information, quantitative means where the numbers are there. Qualitative means where narration is only there, right? For example, you cannot assess the numbers, but for example, you can say that, the company has entered into an agreement with the holding company where the company will wind up after 5 years, right? So this is a qualitative information, not a quantitative information. You all are aware in your notes to accounts, you have some narrative also, right? You have some descriptive information also. Okay. Reclassification. If the company is doing any reclassification, I told you that reclassification is not allowed, but it is only allowed when there is a change in business or there is a change in standard. So whenever the entity is changing the doing the reclassification of one item into the different item, so the entity has to disclose what is the nature of the reclassification, which line item has been reclassified, and what is the reason for the reclassification, right? So these kind of disclosure is going to be happen. Is that clear? So friends, with this, we have discussed the general features or overall considerations of preparation of financial statement, where we have covered the presentation of true and fair view, right? Going concern, accrual basis, aggregation and materiality, offsetting, frequency of reporting, comparative information, and consistency of presentation. We have discussed all these areas, right? So these are the minimum requirement, key features, minimum discipline, which is required for the preparation and presentation of the financial statement. Now, friends, we discussed the overall consideration or the features of the financial statement. Let's move to the structure and content, right? Before that, let me know if you have any questions, if you have any issues. Shankara is asking, sir, if we have a visibility that after 24 months we will discontinue our business, then can we prepare on a going concern basis? In my view, yes, Shankara, you can prepare on a going concern basis, and you can prepare on a going concern basis, and you have to give the qualitative disclosure in your notes to accounts with the clear-cut impact, that what will be the impact after 2 years. Okay, is that clear? Sir, is the valuation allowance is same as revaluation account? Answer is no. Valuation allowance means, for example, you have presented your one of the item on a cost basis. Inventory. What is inventory? You understand inventory? So inventory has to be measured at cost or NRV, whichever is lower. Cost or net realizable value, whichever is lower. For example, cost is 1,000 rupees and net realizable value is 800 rupees. So what you will do? You will put the valuation allowance of 200 rupees. You will net down the inventory, reduce the inventory, or the classic example is debtors, trade receivable. What you are doing? If the trade receivables are doubtful, you are creating a provision on trade receivables, right? You are creating a provision on trade receivables. Okay. So friends, this is known as a valuation allowance. Shruti is saying, sir, in study material, there is a concept called total Shruti, just wait. I have not started statement of profit and loss. When I'll start statement of profit and loss, then I'll cover total comprehensive income, right? It is a part of the statement of profit and loss. So now in this structure and content, I will discuss the structure and content of the component of the financial statement, right? So guys, I would request each one of you that please focus on this PowerPoint presentation, Excel file which I'm using, the concept which I'm explaining, because these concepts are not only theoretical concepts, these concepts are practical concepts also. In today's world, in our examination, there is a huge requirement of have a practical bent of mind, have a practical ability to understand, right? So that is why please focus on the class, and right now don't focus on the study material. After the class, you can refer the study material, I would say. Rajiv is asking, sir, can you please let me know which company can prepare financial statement for 1st January to 31st December or 15 months? So Rajiv, first of all, few companies are following calendar year, right? They are not following financial year. For example, Nestle. Nestle is following calendar year. Uh, if I correctly remember, Ambuja Cements Limited is also following a calendar year. Nestle India Limited and Ambuja Cements. These two companies, in my view, in my knowledge, these two companies are following a calendar year. You can check that. Okay. Or 15 months, friends, 15 months, no one is preparing the financial statement on for 15 months. First of all, why 15 months financials are required? Let's understand that. So I'll discuss and I'll cover it here. So friends, after overall consideration, let's talk about structure and content. This standard is different from IGAP, where in IGAP there was no concept, there was nothing, no guidance which is given on the component of the financial statement. But in Ind AS, the guidance is given for the component of the financial statement as well. For example, if I talk about structure and content, this standard is such a meticulous standard. It says that identification of financial statement says that it should be clearly distinguished from the other information, right? It says that the financial statement in a particular document, the financial statement should be clearly distinguished. Sir, what is meaning of this? Friends, have you ever seen any annual report? Have you ever seen any annual report? If not right now, please download any annual report. Download the annual report of any good company. For example, Reliance Industries. Download that. When you download the annual report, in the annual report, you find a lot of things. For example, in the annual report, you will find board of directors report. In the annual report, you will find corporate governance report. In the annual report, you will find business responsibility report or business responsibility and sustainability report. In the annual report, you will find directors report, board of directors report, BRSR report, corporate governance report. You will also find MDNA, management discussion and analysis report. These all reports are required to be given as per Companies Act and as per SEBI regulations. And after that, in the annual report, there are financial statements, standalone financial statement, as well as consolidated financial statement, right? So friends, Ind AS 1 says that in one set of document, these financial statements should be clearly distinguished from the other information. Talking about the reporting period, right? So friends, the financial statement needs to be reported on an annual basis. The financial statement needs to be reported on an annual basis. At least 1 year financial statement needs to be reported. Okay, at least for a year. To explain if longer or shorter, for example, the company was incorporated on 1st October. So of course, in the first year, they will prepare the financial statement for 6 months only. 6 months is less than 1 year. 6 months is less than 1 year, right? So friends, 6 months is less than 1 year. In this case, the period is shorter. So the management or the company has to explain this in the notes to accounts. that we are incorporated on 1st of October and being the first financial statement. So these financial statement are only for 6 months, which is starting from 1st October and ending on 31st March. Second example, the company was incorporated on 1st January and they are preparing their first financial statement for 15 months. They are not preparing for 3 months. They are preparing for 15 months. So the period is longer than 12 months. So they need to explain this because in Companies Act, the first financial statement can be prepared for 15 months. So they need to report that being the first year of incorporation. So we were incorporated on 1st January 2022, and that is why we have not prepared our first financial statement for 31st March ending 22. So now we are preparing the first financial statement starting from 1st January 22 to 31st March 23. That is for the period of 15 months, right? So this is how it is required to be reported. Otherwise, the minimum reporting period is 1 year. Otherwise, the minimum reporting period is 1 year. Is that clear, friends? Is that clear? Yeah. Information required. What is the information which is required? Name and change in name. Name and change, right? So what is the name of the company? It has to be there in the financial statement. If the company has changed the name, like if you will see the financial statement of Indus Towers Limited, annual report of Indus Towers Limited for financial year 21-22, you will find that on the top of the balance sheet, they are writing like Indus Tower Limited, erstwhile Bharti Infratel Limited, or formerly known as Bharti Infratel Limited. So friends, although there is a requirement of the Companies Act, if you are changing your name, you are required to present it for the period of 2 years, for a period of 2 years at least from the change of the name. But Ind AS 1 also says that if the name has been changed, it is also required to be disclosed and presented. Individual or group financial, is it a standalone financial or is it a consolidated financial statement? This is also required to be disclosed. Period covered. What is the period which is covered, right? Balance sheet as on 31st March, statement of profit and loss for the period ended 30th June, for the year ended 31st March, right? This is also required to be given. Currency, whether the financial statement have been presented in INR, US dollar, euro, that is also required to be presented. Level of rounding off, this is also required to be presented, that the financial statement have been rounded off in which units. This is also required to be presented. I hope it is clear, friends. I hope it is clear to all of you. Yeah. So let me quickly show you one of the annual report so that you will be able to, understand it further. So I have shared the annual report of Hindustan Aeronautics Limited. I believe you are able to see this annual report. Are you able to see this annual report? Let me go to the balance sheet part. Yes. Can you see this balance sheet? So this is the annual report and they have just given the name of the company, Hindustan Aeronautics Limited. This is the annual report and that is why it is like this. Otherwise, when you see the signed balance sheet, the name is always there, right? Like Hindustan Aeronautics Limited. Standalone, they have written, is it a standalone or is it a consolidated, right? And they have also given rupees in lakhs. So they have given the currency, they have given the rounding of unit. Okay. So they have given all this sort of information on the face of the balance sheet and the other component. I hope it is clear to all of you guys. Let me know if you have any doubt. Yes, Vanshika, I have already covered this part, right? This 15 months. Yeah. Guys, do you have any doubt so far? Shall I move forward on the balance sheet part? So friends, now I am going to discuss each and every component of the financial statement, right? Friends, let's talk about the structure and content of the balance sheet. Standard says that in the balance sheet needs to be, the entire item of the balance sheet needs to be classified between current and non-current, right? Between current and non-current. You are aware that. So this is the same requirement which is there in ICAI also, right? So the entire numbers has to be classified between current and non-current. Okay. Friends, if I talk about current and non-current, so the guidance is given in the Indian Accounting Standard also and in the Schedule 3 also. So the basic principle is you need to classify all the item in your balance sheet either into the current assets and liability or into the non-current assets and non-current liability. You can classify on the basis of liquidity if more relevant, on the basis of liquidity if more relevant. Like for NBFC companies, if you see the balance sheet of NBFC company, like you can download the balance sheet of Bajaj Finserv Limited, or let's say Bajaj Finance Limited. You can download the balance sheet annual report of Bajaj Finance Limited. It's a listed company. You can download the financial statement of Bajaj Finance Limited for any year. Let's say for latest financial year 22-23. You will find that the balance sheet of this NBFC is not bifurcated into current and non-current. The balance sheet of this NBFC has been bifurcated into financial and non-financial. Financial means where it can be converted into cash. Non-financial means where it cannot be converted into cash. Why? Because due to the nature of the business, what is the business of banking, NBFC? The business of NBFC is to deal into the money, let's say, right? They are into lending business. Okay. They are lending money, they are getting money. Okay. So for this kind of entity, in spite of current and non-current, this financial and non-financial is more relevant. And friends, that is why division 3 of schedule 3, which is applicable to NBFC companies who are following Ind AS, the balance sheet classification is not current and non-current. It is financial and non-financial, means on the basis of liquidity. This 12 months and this current and non-current is required, but it is required in the notes to accounts for NBFC companies, right? Is that clear, friends? Friends, this Ind AS 1, you remember when I talked about division 2 to schedule 3, I told you that the format of the balance sheet is given in schedule 3, but the guidance regarding balance sheet is also given in Ind AS 1, right? The guidance regarding the balance sheet is also given in Ind AS 1, right? So what happens, let me tell you. Friends, the para number 54 of Ind AS 1, this talks about the minimum line item on the face of the balance sheet. You can see that in Indian Accounting Standard 1, it does not give you a tabular presentation. It does not give you that format. But it says that whenever you are preparing your balance sheet, it should contain, it shall contain, not should contain, it shall contain minimum, these line items. Property, plant and equipment, investment property, intangible assets, financial asset. You will read these all concept in the different standard. For example, there is a Ind AS 16 on property, plant and equipment. There is a Ind AS 40 on investment property. There is a Ind AS 38 on intangible assets. There is a Ind AS 109 on financial assets, right? So all these things needs to be disclosed on the face of the balance sheet. Biological asset as per Ind AS 41. So these are the line item which is there. Sir, whether we need to follow only schedule 3 or this Ind AS 1 also, we need to follow both. For example, this line item non-current asset and liability is classified as held for sale. For example, this line item is not there in schedule 3 presentation. Will you show this line item if it is there in the company? Yes. Why? Because schedule 3 says that whatever I have given you, that is the minimum requirement. If Ind AS has some other requirement, that is also required to be adhered. That is also required to be followed. Right, friends? And as I told you that this Ind AS requirement is beyond and more than the schedule 3 requirement. Okay. So that is why if you are a preparer of the financial statement, or if you are auditor of the financial statement, you need to refer schedule 3 as well as in JSP. Sir, as you told that these are the minimum line item which is required to be presented on the face of the balance sheet. Sir, whether this biological asset I have not found in every balance sheet. What is a biological asset? It is animal or plant. Sir, if the item which is not applicable, for example, Bharti Airtel, Reliance Industries, they don't have biological asset. Sir, do they require to present this biological asset as 00, nil figure? Answer is no. Friend, the standard says that if it is applicable to you, for example, you have a held for sale asset, it is applicable to you, then it is required to be presented separately. If something which is not applicable to you, it is not required to be presented or disclosed separately. Is that clear? Is that clear in mind or clear from mind? Is that clear in mind or clear from mind, guys? HFS means held for sale. Clear, Rajiv? Pooja, Tanisha, Shruti, Vanshika, is that clear? Okay, very good. Very good. So I can see a lot of, responses from the students. Very good. Clear in mind. Thank you, Rahul, for such a nice feedback. Thank you so much. Yes, friends, let's move on. Quickly tell me, as per Ind AS 1, which one of the following item is not required to be shown on the face of the balance sheet? Very simple question. Biological asset, PPE, investment property, contingent liability, intangible asset. Which is the line item which is not required to be presented on the face of the balance sheet? Yes, you are right. Contingent liability. It is not a balance sheet item. It is a off balance sheet item. It is a notes to account side. Yeah. Very good. Friends, now let's discuss current and non-current, right? Although you all are aware, but let's discuss this again. The concept is cut, copy, paste, I would say. What we have already aware, what we are already aware, what we have already read and discussed in IGAP, the concept is same. Friends, as I told you, the balance sheet item has to be classified into current and non-current. But what is the meaning of current assets? And what is the meaning of non-current asset? Friends, the meaning of non-current asset is quite simple. Asset which is not current is non-current asset. But what is the meaning of current asset? That we need to discuss and understand. What is meant by current asset? Current asset means any asset which is expected to realize or intend to sell or consume in the normal operating cycle. So friends, any asset which is going to consume, which is going to sell, or which is going to realize in the normal operating cycle is known as a current asset. Or if the normal operating cycle cannot be identified, if that asset can be realized, sold, or consumed in the next 12 months, right? This will be considered as a current asset. Okay. Or if that asset is held for the purpose of trading, or if that asset is a cash and cash equivalent. Sir, can you give an example for all of these items? Sure. Number one, if any asset which is held for sale, any asset which is held for sale, or I mean to say which is held for the purpose of trading. Maruti. Maruti is manufacturing the cars, vehicles. Doesn't matter if the Maruti would be able to sell those vehicles in the next 5 years, next 4 years, next 2 years, doesn't matter. Maruti will still show those vehicles as an inventory, and inventory has to be shown as a current asset. Inventory will always be shown as a current asset. Right? आपको पता है ना? जरूरी तो नहीं आपने कोई इन्वेंट्री बनाई. रियल एस्टेट बिल्डर, builder has constructed flats. What is the flats for builder? Flats for builder is not a PP, it is a inventory. So वो फ्लैट हो सकता है 10 साल में भी ना बिके, हो सकता है 5 साल में भी ना बिके, राइट. सो वेदर दीज इन्वेंट्री, इफ द बिल्डर एक्सपेक्टेड कि ये 3 साल के बाद बिकेंगे, वेदर दीज इन्वेंट्री कैन बी शोन एज अ नॉन करंट एसेट, आंसर इज नो. Inventory by its nature will always be shown as a current asset. Why? Because it is held for the purpose of trading, means sale. Is that clear? It expect to realize the asset within 12 months after the reporting period. Trade receivables. Trade receivables. You know that these debtors will be collected within 12 months after the reporting period. These are always shown as a current. But if you have a contract to not to demand payment from those customers in the next 2 years, or let's say in the next 1 year, in that case, what will be the classification of the debtors? In that case, the classification of the debtor will be non-current, right? So friends, this is also clear. Now, what is meant by operating cycle? So instead of 12 months, I'll replace it with operating cycle. Operating cycle means cash to cash. Operating cycle means cash to cash, right? Cash to cash. What is meant by cash to cash? For example, the company has purchased a raw material and the company has invested a cash to purchase a raw material. It took 4 months to procure the raw material. It took 4 months. Please write down. It took 4 months to procure the raw material, right? It took 4 months to procure the raw material. Then the company has, started the production. It took around 6 months to complete the production and come with the finished product or the output. So 4 months in the procurement of raw material, 6 months in the processing of the raw material. What is the total? Total is 10 months. Now, after processing of raw material, it took around 5 months to sell that finished goods. So 4 plus 6 plus 5, how much? 15 months. Now, after selling the finished goods, it took 3 months to collection. So total, how much is the total period? The cash which I have invested and the cash which I'm getting. What is the total period? 4 plus 6, 10. 10 plus 5, 15. 15 plus 3, 18. In the 18 months, I am able to liquidate my cash out. Okay. So 18 months before, I have invested cash and now I am getting a cash. So friends, in this case, the cash to cash conversion will take around 18 months, right? So the normal operating cycle where the cash will be converted into a cash is 18 months, right? So in this case, this is considered as a normal operating cycle. Friends, anything which is expected to realize, which is expected to sell, or which is expected to consume is considered, anything which is expected to sell, consume, or realize within 18 months is considered as a current asset. Why? Because the normal operating cycle is 18 months. Sir, what is the general rule? What companies are doing generally? Generally, if you will pick the top Nifty 50 companies, generally the companies are referring 12 months cycle. Okay. The companies are referring 12 months cycle for current and non-current, Is that fine, friends? Is that fine? Is that clear? So this is the meaning of current and non-current. So we discussed this part, and this part. Now let's talk about cash or cash equivalent. What is meant by cash or cash equivalent? The asset must be a cash and cash equivalent. So cash, you understand, cash means liquid cash, hard cash. Cash equivalent means any item like cash at bank, fixed deposits, okay. Any item which can be converted, any item which can be converted into a cash within a short term. Within a short term means within 3 months, right? Any item which can be converted into a non amount of cash, मतलब पता होना चाहिए कितना convert होगा. Any item which can be converted into a non amount of a cash, which does not have a significant risk of change in value in the short term period. For example, the company has invested in fixed deposits for the period of 3 months. So short term period means 3 months. So what is this fixed deposit? This fixed deposit is a cash or cash equivalent. Cash equivalent. Why? Because the company knows that if I have invested today 1,000 rupees, after 3 months I'll get 1,010 rupees including interest. So the company know the amount of cash which the company will be getting. And there is an insignificant risk of change in value. And the company knows that the value will not change. Right? But let's say the company has invested in the share of Infosys or in the share of Adani Enterprises. Can the company realize cash immediately? Answer is yes, because it's a listed company. For example, company has purchased today, the company can sold it tomorrow. So the company can realize cash. Now the question comes, if the company has realized cash just within a period of 1 day or 2 days, the company can realize cash. Can the company call that investment in shares as a cash equivalent? Can the company call investment in share as a cash equivalent? Answer is no. The company cannot call that investment in share as a cash equivalent. Why? Because the company does not aware that what amount of cash the company is going to be received tomorrow. If the market will crash, probably the shares will go down by 20%, 30%, let's say. If the market will up, probably the share will up by like anything. Are you getting me? So friends, there is a huge risk of change in value. There is a huge risk of change in value, number one. Number two, the company is not able to aware that if the company has invested 1,500 rupees, whether the company will be able to get 150 rupees or 3,000 rupees. The company is not able to understand that. The company is not able to aware that. So this investment in shares is not a cash and cash equivalent. Okay. Understood? So friends, what is a current asset? Anything which is going to be realized within normal operating cycle, which is held for the purpose of trading, which is expected to realize within 12 months, or which is a cash or cash equivalent. Any asset which is not current is considered as a non-current asset. Okay. Now, friends, what is meant by current liability? Simple. Current liability means those liability. See, friends, earlier we were talking about asset. Now we are talking about obligation. When we are talking about obligation, so we should be more meaningful and mindful about the contract, about the contractual term, not by the intention. For example, here we are talking about the expectation. If we are expecting to realize, right? अगर हम expect कर रहे हैं कि हमें मिल जाएगा पैसा, तो वो current होगा अगर within operating cycle या within 12 months. But friends, this kind of a case is not there in case of a liability. In liability, you will say that I am expecting not to pay in the next 12 months. Right? So मैं कह रहा हूं कि अगले 12 महीने में I'll not pay to my creditors. So I am showing it as a non-current liability. So friends, the expectation was there in the asset side, but the expectation is not there in the liability side. Why? Because the asset is something which is going to be realized from the outsider, from the third parties. Liability is something which is originating from the inside the company. The company has to pay. So if the expectation would have been shown, if the expectation would have been shown in the liability side also, then probably the management will start playing. अगर मैनेजमेंट को करंट रेशियो ठीक करनी है तो मैनेजमेंट कहेगी मैं लाइबिलिटी पे नहीं करने वाला अगले 12 महीने. The management will start playing with the numbers. The management will start playing with the ratios. That is why on the liability side, expectation is not there. On the liability side, contractual terms are there. Is it due? For example, if it is due to be payable within 1 year, it has to be shown as current. And the classic example is current maturity of long-term borrowing. You must be aware about the current maturity of long-term borrowing. For example, if you have taken a loan for 5 years and you have to pay the installment on that loan, you have to pay the installment on that loan, right? So friends, the installment which are getting due in the next 1 year, the installment which are getting due in the next 1 year has to be shown as current. Why? Because it is due in the next 1 year. So that portion has to be shown as current. And after 1 year to fifth year has to be shown as non-current. Doesn't matter you will pay or not. It is due to be payable within 1 year. So friends, first of all, current liability is a liability which is due to be settled within operating cycle or within 12 months from the reporting date. The liability which is held primarily for the purpose of trading, or no unconditional right to defer the settlement for at least 12 months is there. No unconditional right to defer the settlement. For example, friends, leave encashment. And this is one of the classic example which I want to give you. If you will see the leave encashment, you know what happens with the leave encashment? Normally, let's say the employee who has served for a period of 1 year, he is entitled to have a leave balance of 30 days. And he can carry forward that leave balance, right, of 30 days. Friends, if the employee wants to avail the leave for 30 days in the next year, his salary will not be deducted, right? Why? Because he has a leave balance of 30 days. So if he'll go for a leave for 30 days, probably yes, he can go for the leave for 30 days and his leaves will be adjusted and his salary will not be deducted. So friends, in this case, the company does not have any unconditional right to defer the settlement for at least 12 months. The company cannot say that you cannot take a leave, right? Although I'm saying from the background that the boss can request or boss can say that please don't take leave. Okay. But let's say if the employee got sick, right? Employee fell ill. So employee was bound to take a leave. Now the question arises, can those leave encashment liability will be adjusted? I mean to say those leaves will be adjusted or the salary will be deducted. Of course, leaves will be adjusted because the company does not have any unconditional right to defer the settlement of this leave encashment liability for more than 12 months. Are you getting me? So friends, in this case, you can find a lot of companies who are showing this entire leave encashment liability as a short-term liability, as a current liability. Why? Because they don't have any unconditional right to defer the settlement beyond 12 months. Understood? But let's say the company which is there, which says that in the agreement, in the offer letter, in the appointment letter, there is a clause which is signed by the employee that the employee will take the leave. The employee will take the leave only to the extent of 15 days from the carry forward balance in the next year. Okay, in that case, even though if the 30 or 40 days leaves are there in his credit, he can only avail 15 days from the last balance, right? From the last balance. Is that clear? Is that clear, friends? Yeah. In that case, the 50% portion has to be shown as current liability. The remaining 50% portion has to be shown as a non-current liability. I hope it is clear to all of you, friends, right? So liability which is not current is considered as a non-current liability. Liability which is not current is considered as a non-current liability. So on current and non-current, I have few questions and let me discuss from the study material, right? Let me know if the study material is visible. Is that visible? Term deposits for less than 3 months are cash equivalent, yatharth, right? This cash and cash equivalent we will discuss in detail tomorrow in the in the 7th statement of cash flows. Okay. Let's quickly discuss illustration number 13. An entity has taken a loan facility from a bank that is to be repaid within a period of 9 months from the end of the reporting period. Friends, reading the first line, what is your view? Whether this liability is current or non-current? After reading the first line, what is your prime view? Is it current or non-current? Of course, current. Just reading the first line. Let's go further. Prior to the end of the reporting period, the entity and the bank enter into an arrangement. Before closing, they have entered into an agreement whereby the existing outstanding loan will unconditionally roll into the new facility, which expires after a period of 5 years. Friends, so on the reporting date, the loan was repaid within 9 months, right? But before this reporting date, the company and the bank have agreed, entered into an arrangement, they have agreed that this loan has to be rolled forwarded into the next 5-year term unconditionally. Unconditionally, right? There is no condition, unconditional. So on the reporting date, whether this loan is repayable within 9 months or within 5 years, whether this loan is repayable within 9 months or within 5 years, tell me. Of course, within 5 years. So the first question is, how should such loan be classified in the balance sheet of the entity? You tell me, current or non-current? You tell me, current or non-current? Of course, non-current. Let's discuss how this solution has been given. Let's discuss the solution. The loan is not due for payment at the end of the reporting date. The entity and the bank have agreed for the said rollover even prior to the end of the reporting date for a period of 5 years. Since the entity has an unconditional right to defer the settlement of the liability for at least 12 months after the reporting date, because it is 5 years, the loan should be classified as non-current. Very simple. Very simple, guys. Very simple. Right. Now let's discuss about the next question. Will the answer be different if the new facility is agreed after the reporting date? On the reporting date, it was 9 months, but it was agreed after the reporting date. Tell me whether your answer would be different. Tell me what should be your answer. Friends, you are preparing your balance sheet on the reporting date, right? Clear? And on the reporting date, this loan was current because it is repaid within 9 months. And this arrangement has happened after reporting date, means it is a non-adjusting event. The disclosure is required, but this loan has to be shown as a current liability. Yes, the answer will be different if the arrangement for rollover is agreed after the end of the reporting date, since assessment is required to be made based on the terms of the existing loan facility. As on the end of the reporting date, the entity does not have any unconditional right to defer the settlement of liability for at least 12 months beyond the reporting date. Hence, the loan has to be classified as current. I hope it is clear to all of you. It is not a case of loan covenant, default of loan covenant. It is a case of where the existing loan facility is about to be repaid within 9 months, and the company and banker has agreed after reporting date to defer this loan facility. Is that clear? I hope pretty simple. Will the answer to A be different if the existing facility is from one bank and the new facility is from other bank? Friends, instead of rollover, what the company wants to do, the company has to pay to the one bank and the company has to take the 5-year loan from the other bank. The company has to pay this money to the one bank, which is due to be payable within 9 months, and the company has to get the money from the other bank. Right. In this case, what will happen? Of course, in this case, still it will be a current liability. It is not a rollover. It is more like you're discharging the obligation towards one bank and you are taking an obligation from other bank. Right? So yes, loan facility arranged with the new bank cannot be treated as refinancing, as the loan with the earlier bank would have to be settled, which may coincide with the loan facility arranged from a new bank. In this case, loan has to be paid within a period of 9 months from the end of the reporting period. Therefore, it will be classified as a current liability. Right? You understand? The company does not have an unconditional right to defer the settlement of this first bank. The company has to pay the bank within 9 months. So it is a current liability. It is not a rollover. Right, friends? I hope you have understood. I hope you have understood this thing. Okay. So let's go further. Very good case study to understand the current and non-current liability. Will the answer to A be different if the new facility is not yet tied up with the existing bank, but the entity has the potential to refinance the obligation? Friends, so now it is saying that the current liability, the loan which is going to be repaid within 9 months, the company is discussing with the banker, and the company is quite sure, the company is expecting that the banker will roll over this loan for the 5 years. So friends, before the reporting date it was not agreed, but the company expect that yes, it will be done. The company has a potential to refinance. So friends, whether the liability, current and non-current, will be classified on the basis of potential, answer is no. It will be defined on the basis of contractual terms. So in this case, the answer will be different and the loan should be classified as current, right? This is the because, just don't talk about paragraph. This paragraph is regarding current and non-current. When refinancing or rolling over the obligation is not at the discretion of the entity, if tomorrow bank will deny, of course, the company has to pay. The entity does not consider the potential to refinance the obligation and classify the obligation as current because the company does not have an unconditional right to defer the settlement beyond 12 months. So friends, this was about current and non-current. Please let me know if you have any question on this current and non-current liability. Please let me know if you have any question. No? Very good. I hope you guys have well understood. Very good. Inventory or trade receivable of Pluto Limited are normally realized in 15 months. Should Pluto Limited classify such inventory or trade receivable as current? Answer is no. Why? Because the operating cycle is 15 months in this case. It will be considered as 15, right? So carve out, you remember in the first class, I have discussed the carve out. For example, if there is a long-term loan, right? And this long-term loan has been classified as non-current in on the reporting date. And on the reporting date, the company has made a default. Due to the default, this loan has become a current loan. Now, before approval of the financial statement, the company has agreed with the banker that the banker will not demand the payment. So in this case, it will be considered as an adjusting event and still the company will show this liability as a non-current liability. But in IFRS, it has to be shown as a current liability. You can refer the video of the day one to understand this carve out. And friends, let me tell you again, this carve out will again be repeated in Ind AS 10 because it talks about the adjusting and non-adjusting event. And that is why this carve out will be discussed in Ind AS 10 also. Like I have told you, the concept of third balance sheet will get revised in Ind AS 8. The concept of this carve out will also get revised in Ind AS 10. So I'm not covering this again. Now coming to the statement of profit and loss, where I will be discussing the comprehensive income also. So friends, it's 8:30 now, 8:33 now. Let's have a break of 5 minutes. We will start at 8:39 because it's 8:34 now. We'll start at 8:39. Okay. answer, it is current. It is within operating cycle, right? So it should be current. Have I told non-current? I think I have told no current only. Yeah, I have told only current, right? So anything which is going to be realized within 12, within 15 months, it will be current only. Right? Yes. So these inventory and trade receivables should be classified as current. Okay, guys. So let's discuss the statement of profit and loss. And friends, I'll explain this concept with the help of this Excel file. The entire statement of profit and loss. Friends, this Indian Accounting Standard 1 is a very fundamental standard. It's a very conceptual standard. And more than exam, this standard will help more you in the real life, right? So let's discuss statement of profit and loss. Oh, sorry, Pooja, my bad. So if I have told it as a non-current, that was wrong. It should be current, right? It should be current. So friends, the example which I have taken, the inventory and trade receivables is going to be realized in 15 months normally. It means the operating cycle is 15 months, right? So such inventory and such trade receivable will always shown as current. Why? Because the operating cycle is 15. If I have told you non-current, that was not right. The answer is current, which is right. Okay. Yeah, let's talk about statement of profit and loss for the year ended 31st March 2023. And friends, I would like you to please write down 5 things in the statement of profit and loss. Please write down. Number 1, Ind AS 1 prescribes. Ind AS 1 prescribes. Ind AS 1, please write down. Ind AS 1 prescribes the minimum line item on the face of the profit and loss. Schedule 3 gives the format of profit and loss with the line items, but Ind AS 1 also prescribes minimum line item on the face of the P&L. Minimum line item like revenue, like depreciation, finance cost, tax. These kind of a minimum line item has been given in Ind AS 1. So it says that at least these items should be there in your profit and loss, right? It is not detailed. It is just given 5-6 line item. So of course you need to refer schedule 3 and you need to also compare with Ind AS 1. If there is a particular requirement of Ind AS 1 which is not there in schedule 3, so that requirement also needs to be followed. Number 1, Ind AS 1 also gives the minimum line item on the face of the P&L. Number 2, Ind AS 1 prescribes only the nature-based classification. The nature-based classification of expenses. The nature-based classification of expenses. The nature-based classification of expenses, right? The nature-based classification of expenses in the profit and loss, in the statement of profit and loss. Friends, in the first class, in overview and roadmap for implementation of Ind AS, I have explained that there are 2 classification of expenses in the P&L. One is function based, one is nature based. Function based means like depreciation. Depreciation on factory building is shown as a factory overheads, and depreciation on office building has been shown as office overheads. This is a functional classification. What is a nature based classification? Doesn't matter. The depreciation belongs to factory or office. If it is a depreciation, it has to be shown as a single line item, known as a depreciation, right? That is how it is going to be disclosed. Okay. So first I told you Ind AS 1 prescribes minimum line item on the face of the financial on the face of the P&L, like revenue, finance cost, tax, depreciation and impairment. Number two, the expenses is required to be classified only on the basis of nature-based classification. If you want to understand nature-based classification, I have already covered in detail on the day one. Number three, the format of statement of profit and loss also includes a new section called as other comprehensive income. Other comprehensive income, right? So there are two parts of statement of profit and loss, part one and part two. Part one is a normal P&L, which you have always shown, which you have always seen the normal P&L, and part two is your other comprehensive income, right? Number four, please write down number four. The total of profit after tax, the total of profit after tax plus other comprehensive income is known as total comprehensive income. The total of profit after tax plus other comprehensive income is known as total comprehensive income, right? Number five, earnings per share has to be calculated only on profit after tax, only on profit after tax. Number six, please write down. There is no concept of extraordinary item and prior period item in Ind AS. There is no concept of extraordinary item and prior period item in Ind AS. Number seven, there is only concept of exceptional item in Ind AS. There is only concept of exceptional item in Ind AS. I hope you guys have written down these 7 points. Oh, yeah. Now let's start with. Friends, this is a normal P&L which I am showing. Revenue is there, other income is there, total income is there, employee benefit expenses, other expenses, impairment, depreciation, finance cost. This all is there. This is your profit before tax and other item, right? And friends, then there is an extraordinary item. There is an extraordinary item. So friends, there is no extraordinary item. This extraordinary item is prohibited under Ind AS and IFRS. This exceptional item is allowed under Ind AS and IFRS. This prior period item is prohibited under Ind AS and IFRS. Why? You remember I have told you third balance sheet. So the error cannot be corrected by just giving a line item prior period expenses. The error needs to be corrected by comparative restatement and by the restatement of the opening Ind AS balance sheet of the comparative year, right? So my dear friends, prior period item is not allowed to be shown as a separate line item in the face of the P&L. This requirement was there in IGAP, but this is not there in Ind AS. Number one. Number two, extraordinary item requirement was there in IGAP, but this requirement is not there in Ind AS. Right. But exceptional requirement is there. Sir, what is the difference between extraordinary item and exceptional item? Friends, please write down. Extraordinary item, I am talking the definition more from the accounting standard point of view, right? Please write down. Let me show you here also. I have also given. Extraordinary item are those items which are not in the ordinary activity of the entity. This definition is from accounting standard, not from Ind AS. Extraordinary item are those items which are not in the ordinary activity of the entity. For example, loss of inventory due to fire, robbery of cash, embezzlement of cash, loss due to earthquake. Is it an ordinary activity? It is not an ordinary activity. Right. What is an exceptional item? Exceptional item are those items which are in the nature of ordinary activity of the entity. But it requires separate disclosure. Why? Due to the size and the nature. Let me give you an example of both the things. Friends, exceptional item are the ordinary item. Extraordinary item are the non-ordinary item. For example, having a loss due to earthquake, is it ordinary activity of the entity? Answer is no. So that is why this extraordinary was there in India, because AS is related to India only. IFRS are the global standard. When this global standard made in IFRS, there is no concept of extraordinary. It says that if you are doing a business, there is always a risk of robbery, always a risk of embezzlement of cash, always a risk of loss due to earthquake. There are some jurisdictions where even earthquake is normal. In Japan, there are a lot of earthquake, right? So in some jurisdictions, flood is normal. So when you are doing a business, these things may happen. So that is why in IFRS, there is no concept of extraordinary, right? So if these kind of expenses are there, either it has to be shown as other expenses or it has to be shown as exceptional item if the amount is material or significant. Is that clear? Since it's a global standard, so the horizon is more from the global perspective. So you understand extraordinary item is not there, but in Indian GAAP, in AS, this was separately presented. What is exceptional item? It is ordinary in nature, but require a separate disclosure due to the size and nature. For example, and I'll give you a real life example. The telecom companies are paying a license fee to the DOT as a 8% of their revenue, as a 8% of their revenue. Every quarter they are paying to the Department of Telecom. Friends, in the year 1920, Supreme Court come with an announcement to the telecom companies, come up with a verdict to the telecom companies where a liability of a case was going on this dispute of license liability, AGR liability, a case was going on since last 10-15 years. In the year 1920, Supreme Court announced that Bharti Airtel needs to pay around 35,000 crore and Vodafone Idea needs to pay around 60,000 crore. So friends, paying a AGR, paying a license fee is an ordinary activity. Every quarter they need to pay. But due to the Supreme Court verdict, they are required to pay a huge amount of money, including interest and penalty. They are required to pay a huge amount of money, including interest and penalty. Do you think it is a normal? Do you think that this kind of demand will come every year? The company will not able to survive if this kind of demand will come every year, right? So friends, although this paying a AGR, adjusted gross revenue liability, is normal in nature, is ordinary in nature, but due to this one-off event, this number is huge, and that is why Vodafone Idea and Bharti Airtel both have shown this amount as an exceptional item in the P&L. Exceptional item in the P&L. Understood? Understood? Right? For example, a second example, provision for bad debt is normal item in the ordinary course of business. But a huge loss on account of insolvency of one of the largest customer of the company required a separate disclosure as an exceptional item. You understand the meaning of extraordinary item and exceptional item? So extraordinary item is not allowed in Ind AS, but exceptional item is allowed in Ind AS. Right? Is that clear? Is that clear? Prior period item is not allowed in Ind AS and IFRS. So and then profit before tax, then tax expenses, then profit after tax. So friends, our IGAP P&L got ended here. हमारा IGAP का P&L यहाँ खत्म हो जाता, right? This got ended here. But in Ind AS, there is a second section known as other comprehensive income. And I called it as a part 2 so that you will be able to understand. Yeah? Is that clear? Friends, now coming to this other comprehensive income. What is this other comprehensive income? ये क्या बला है? What is this other comprehensive? Friends, first of all, let me tell you about some other comprehensive income guidance. Please write down. Other comprehensive income is a new section in the profit and loss, in the statement of profit and loss. Number 2, the rule-based guidance is given in the other comprehensive income, which includes 9 items. So friends, there is a fixed list of other comprehensive income item. There are around 9 items in other comprehensive income. Friends, there are very limited guidance on other comprehensive income, but with my experience, let me tell you, other comprehensive income is like a reserve category in nature. Other comprehensive income includes non-cash item, it includes non-cash item, and it includes other comprehensive income includes non-cash item, and it includes generally notional item, non-cash and notional item, which is more like a reserve in nature, right? Which is more like a reserve in nature. And let me tell you why this concept of other comprehensive income is there. Friends, other comprehensive income comprises item of income and expenses which are not recognized in profit and loss as required or permitted by other Ind AS. Other comprehensive income comprises of income and expenses that are not recognized in profit or loss as required or permitted by other Ind AS. Friends, what is other comprehensive income? So other comprehensive income are those items which are required to be recognized in statement of profit and loss, but it is not required in part 1. It has to be required to be recognized in other comprehensive section H per few Ind AS. So friends, there are few Ind AS, as I told you the 9 items, there are few Ind AS which says that this item has to go to OCI. I'll discuss one by one. But why this OCI concept is there? So let me explain. Friends, there is a definition of income and expense. You must have read the definition in your conceptual framework for financial reporting. You must have read that definition of conceptual framework for financial reporting, right? Now, what is the definition of income and expense? The definition of income and expense is nothing. It is what? It says that whenever there is an increase in net assets. So what is income? Income is increase in net assets, right? Income is increase in net assets due to a transaction which is happening with the party other than the shareholder. So increase in net assets due to a transaction happening with other than shareholder. What is expense? Expense is decrease in net assets due to transaction with the non-shareholder, with the other than shareholder. Means if a transaction is happening with a shareholder, and then whether your net assets is increasing or decreasing, it is not your income and expense. But if a transaction is happening with a party other than the shareholder, and then your income and expense is increasing or decreasing, then it is your net assets is increasing or decreasing, then it is an income and expense. So I'll give you one example to that. For example, dividend. Payment of dividend. Friends, what is net asset? Net assets means asset minus liability. Payment of dividend. When you pay dividend, whether your net assets will increase or decrease or nothing. Of course, it will decrease. Why? Because your cash will go out, because your retained earnings will go down, right? So your net assets will decrease. Your assets minus liability will decrease. Yeah. Your asset minus liability will decrease. Friends, whether this transaction is with shareholder or other than shareholder, this transaction is with shareholder. Is it meeting the definition of income and expense? No, not meeting the definition of expense. Not meeting the definition of expense. Right? Is that clear? So that is why this dividend has to be shown in the statement of changes in equity, directly reduced from retained earning in the reserves. No P&L. Right issue. By right issue, net assets will increase because the equity share capital will come. It will increase. But whether this transaction is with shareholder or other than shareholder, this transaction is with shareholder. So it is not meeting the definition of income. It is not meeting the definition of income. It is not meeting the definition of income. Is that clear? Is that clear, friends? I am just giving you why the concept of other comprehensive income came. Before that, I am telling you the concept of income and expense. Yeah. Is that clear? So other comprehensive income includes losses as well. Negative income means losses. Friends, revaluation surplus on fixed asset. The company has done the revaluation of fixed asset, and with this, net assets will increase or decrease. Let's say there is an upward revaluation, so net assets has increased. Of course, increase. Whether this increase in net asset, this revaluation surplus, whether this transaction is happening with shareholder, answer is no. No, it is a market-based transaction. The company is restating, revaluing its fixed asset on the basis of market value. So this transaction is not happening with the shareholder, not with the shareholder. This transaction is not happening with the shareholder. So whether it is meeting the definition of income, yes, it is meeting the definition of income. So friends, don't you think if it is meeting the definition of income, and if we will take this income here, other income, not revenue from other income, don't you think this revaluation surplus is more like a reserve? And if we'll cover here in other income, there is a risk of distribution of dividend. There is a risk of distribution of dividend out of it. Don't you think that? There is a risk of distribution of dividend. Yeah. Yes. So do you think that we need to, if it is meeting the definition of income, do you think we need to cover it in the other income in the part 1 of the P&L? Answer is no. Answer is no. Because it is a notional amount. It's a reserve. It's a notional amount. So where we should take it? Where we should take it? What do you think? Where we should take it? Tell me, what is your view? Where we should take it? We should take it in other comprehensive income, into the second section of the profit and loss, into the second section of the profit or loss, right? Understood? Into the second section of the profit or loss. You remember point number 5 or point number 6 where I have told you that the earning per share has to be calculated on profit after tax, which is the final line item of the part 1. It is not on the other comprehensive income, right? I have told you that thing. You remember that? I have told you, you remember that? Is that clear? So it has to be covered in the other comprehensive income. And where it is written that? It is written there in Ind AS 16. Ind AS 16. The second example, foreign currency translation reserve. When you are consolidating your foreign currency financial statement, there is an impact of exchange differences. So let's say there is a favorable impact of exchange difference and there is a positive translation reserve. So your net assets will increase. So when your net assets will increase, or let's say take it different, your net assets are decreased, there is a negative impact. Whether this transaction is with the shareholder, answer is no. Whether it is meeting the definition of expense, answer is yes, it is meeting the definition of expense. So friends, this foreign currency translation reserve is a reserve. Do you think we need to take this expense in the P&L? In IGAP, we take it to the reserve. Do you think we need to take it as a other expense in the P&L? Answer is where we should take it. Ind AS 21 says that we should take it to the other comprehensive income. Have you understood this? Again, repeating and summarizing. Other comprehensive income is like a reserve category. It's like a reserve section. Where the notional amount or non-cash item has to be covered. Sir, depreciation, will it come under other comprehensive income? Where the depreciation is kind of a reserve in nature? Answer is no. Depreciation is a P&L item. So, friends, not all non-cash, not all notional will come here. 9 items, 9 items which is written in the Ind AS 1 and which is coming from different Ind AS. There is a list of 9 items. You can refer my PPT or you can refer study material where you need to remember those 9 items which are part of other comprehensive income, right? Is that clear? Now, Shruti was asking, sir, what is total comprehensive income? So profit after tax plus the total of other comprehensive income is known as total comprehensive income, right? So friends, earning per share needs to be calculated only on profit after tax, not on the total comprehensive income. Is that clear? So this is a new term which is known as a total comprehensive income and other comprehensive. Now this other comprehensive income has 2 parts, right? Item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. What is the meaning of these 2 items? Friends, You may have a question, sir. Okay, we understood that revaluation surplus or foreign currency translation reserve should go to the P&L. P&L means OCI. Okay. Sir, when the company will sell that asset, where the balance of this revaluation reserve will go, which is part of OCI. You understood, for example, the company has revalued a building in the current year. So the company has recorded a revaluation reserve or revaluation surplus of 50 crore. In the next year, the company has sold that building. So this revaluation surplus still sitting here. So where it will go? So friends, for OCI, Ind AS 1 says that for OCI, there are two parts of OCI. Number one, item that will be subsequently reclassified to P&L means at that time of disposal, the OCI will recognize in P&L means part one. Number two, item that will not be reclassified to P&L means at the time of disposal, the OCI will be recognized in the retained earning directly in the balance sheet. What does it mean? For example, this revaluation surplus, which is there, what will happen? This revaluation surplus is now OCI reserve. So this revaluation surplus OCI reserve at the time of disposal, of asset, the accounting entry will be revaluation surplus OCI reserve debit and retained earning will be credited. So it's a balance sheet to balance sheet entry to retained earnings. Right? So in the next year, what will happen? Like in this year, you have a 200 positive balance in OCI in the name of revaluation surplus. In the next year, you will have a negative balance in OCI, right? You have a negative balance in OCI. Okay. And you have a positive balance in retained earnings. Okay. So this is balance sheet to balance sheet. What about the foreign currency translation reserve? If you have a foreign subsidiary and that foreign subsidiary got disposed of, you have the foreign currency translation reserve, for example, positive. So what entry will be there? Foreign currency translation reserve, FCTR OCI reserve, FCTR OCI reserve will be debited to other income or other expenses, P&L, right? So this is a balance sheet to P&L entry. This is a balance sheet to P&L entry because OCI reserve is more like a balance sheet item, no? This is your balance sheet to P&L, and this is your balance sheet to balance sheet entry, right? Is that, sir, where it is written? It is written in the respective standard. Like Ind AS 16 says that such revaluation surplus will go to OCI, and then this revaluation surplus will go to retained earning at the time of disposal. Ind AS 21 foreign exchange standard says that such FCTR will go to OCI, and at the time of disposal of foreign entity, so this FCTR will transfer to the normal P&L, right? So this is balance sheet to P&L, this is balance sheet to balance sheet. Sir, what about the tax impact? So the deferred tax impact will be there on the OCI item, and this deferred tax P&L impact has to be shown in the OCI only for these items, right? So this is how the statement of profit and loss needs to be presented. Now, friends, let me show you one of the annual report, and please let me know if the annual report is visible so that you will be able to summarize what I have told you. Let me know if you are able to see the annual report of statement of profit and loss of Hindustan Aeronautics Limited. You can see this statement of profit and loss, not or loss, right? For the year ended this. These are the comparative number also. Rupees in lakhs. There is a revenue from operation, other income, okay? And then there is your expenses part where the other items are there, okay? You can see that there is a exceptional item which is there. There is no extraordinary item, there is exceptional item. Then there is a profit for the period which is nothing, profit after tax. This is part one which we have discussed. And after that, friends, we have other comprehensive income. In other comprehensive income, we have item that will not be reclassified to P&L, item that will be reclassified to P&L. When? At the time of disposal, right? You can see that there is a negative item also. So for example, item that will be reclassified to P&L will not be reclassified is this much. There is a deferred tax impact, right? And so after profit after tax and this other comprehensive income, there is a total of other comprehensive income and there is a total comprehensive income. There is a total comprehensive income, right? There is a total comprehensive income. So this is how this has to be shown. And this is earning per share. Earning per share is only on the profit for the period, not in on this total comprehensive income, right? Is that clear, friends? Is that clear? So Pooja, the accounting entry is, let's say a revaluation surplus is there and the company has disposed of that fixed asset in where that revaluation surplus was there. So what you will do? You will debit the revaluation surplus because the underlying asset is not there. But what you will credit? You will credit the retained earnings, right? So this is for revaluation surplus because this is an item which will not be reclassified to P&L. It's a balance sheet to balance sheet. This OCI will become part of the reserve. Let me show you. In the same balance sheet, again, now we are discussing statement of changes in equity. So friends, you can see this other comprehensive income, right? So this other comprehensive income will be shown as a separate reserve and the profit for the period has to be shown as other retained earnings, right? The profit has to be shown in the retained earning, other comprehensive income has to be shown separate. Is that clear? Is that clear, friends? I hope it is clear. Okay, let's move on. So statement of changes in equity is nothing. It's a movement in capital and movement in reserves and surplus. That's all. So this is your statement of changes in equity. No much guidance is there for statement of changes in equity. I have already covered in detail in my first in my last session on Ind AS 1. So let's go back to the presentation. So friends, you can see this. This is your whatever I have explained you. This is your structure of statement of profit and loss. This is what I have discussed. This is your minimum line item. Okay. This is your item that will not be reclassified to P&L. Item that will be reclassified to P&L. I have given the list of the item. Right. You just need to learn and remember the list. The item which will the item you will be able to understand when you read the respective standard. For example, 4 item is relating to the financial instrument standard. So when you read Ind AS 109, you will be able to understand these concepts, right? So friends, what about your statement of cash flows? So first balance sheet we discussed, P&L we discussed, statement of changes in equity we discussed. What about statement of cash flows, friends? Regarding the statement of cash flow, standard says that the statement of cash flow has to be prepared in accordance with Ind AS 7. In accordance with Ind AS 7. Tomorrow we'll discuss Ind AS 7. So Ind AS 1 does not gives any guidance about statement of cash flow. It only says that you need to refer Ind AS 7 for statement of cash flow. Now the last component, which is your notes to accounts. What is your notes to accounts? Friends, standard says that the notes cell present information about the basis of preparation of the financial statement and the specific accounting policies. Right? You can see that in this Hindustan Aeronautics Limited balance sheet, you can see the company has given the basis of preparation where the basis of accounting is there, use of estimates are there, right? And then the company has given the accounting policies, specific accounting policies. So the notes shall present the information about the basis of preparation of the financial statement and the specific accounting policies, right? Same, which we were already doing in our IGAP scenario. Disclose the information required by Ind AS that is not presented elsewhere in the financial statement. Tell me, what are the kind of information which is required to be disclosed in the notes to accounts as per respective Ind AS, which is not there in balance sheet, P&L, cash flow, statement of changes in equity? What kind of information are there? Related party disclosure. It is required by Ind AS 24. Segment reporting. It is required by Ind AS 108. Right? Actuarial disclosure. It is required by Ind AS 19. Right? Is that clear? Is that clear, friends? Contingent liability. It is required by Ind AS 37. Provide information that is not presented elsewhere in the financial statement but is relevant to an understanding of any of them. Breakup of all the balance sheet item, breakup of all the P&L item. For example, your PP is placed to the bank. Your shares are placed. Like if I talk about Ambuja Cements, okay, not Ambuja Cements. Let's say the shares of the Adani entities which are placed. Okay, so those shares, if those shares are placed, right? So this information is required to be given in the notes to account so that the user will be able to understand the situation, right? And take the decision accordingly. Is that clear? Is that clear, friends? Clear in mind or clear from mind? What is that? Clear in mind? Very good. This even in days one says that what could be the sequence of the notes to accounts. It says that the first should be your statement of compliance with Ind AS. You remember? I've shown you the statement of compliance with Ind AS in your Ind AS, in your study material where TCS disclosure is there. Summary of material accounting policies applied. Significant accounting policies. The name has been changed to material accounting policies, which you will read in Ind AS 8. Supporting information for financial supporting information for item presented in the financial statement in the order in which each statement and each line item is presented. What is that? What is that? The breakup of the balance sheet. For example, let me show you what it is talking about. The breakup of the balance sheet, right? The breakup of the balance sheet, the breakup of the P&L, like you have seen that in your entire balance sheet and P&L, there is a note referencing, right? There is a note referencing. You can see that. In your balance sheet, you can see that there is a note referencing, right? Note number 22, 23, and this is in sequence. In your P&L, again, this note number is in sequence. So what you are giving? You are giving the breakup of these line items in the notes to accounts. Okay. Other disclosure. What is other disclosure? Like related party, contingent liability, capital commitment, segment reporting, actuarial related disclosure, forex related disclosure. So these disclosures are required to be given here. Is that clear? Clear in mind or clear from mind? Clear in mind. Very good. Friends, one of the most important part in the notes to accounts is what it is. It is what? One of the most important part is your, apart from accounting policies, you know, your balance sheet consists of a lot of line items. Your balance sheet consists of a lot of line items. Okay. Where the numbers are not accurate, the numbers are estimated. For example, provision for leave encashment, provision for gratuity, provision for leave encashment, provision for gratuity, right? Where there is an estimate, the numbers are estimated, the numbers are estimated. Okay. So friends, in this case, what happens? Like leases. In leases, there are a lot of estimates which are required to be covered, right? In property, plant and equipment, the policy is different and the estimates are different. But the policy, what is the policy? Policy means like depreciation is required to be charged on the fixed asset. It is a policy. But depreciation is required to be charged on the useful life of the fixed asset is a policy. But what is the useful life? It's an estimate. So friends, one of the biggest area or one of the biggest change I would say in Indian accounting standard is your requirement of critical management estimate disclosure in the notes to accounts in addition to your accounting policies, right? And let me show you with the help of the annual report. Let me show you. I hope the annual report of Adani Enterprises Limited is visible. I hope this annual report is visible. So let's go to that part. You can see that in the notes to accounts, in the corporate information, you can see that, sorry, in the notes to account, they have started with the corporate information, then basis of preparation, statement of compliance, right? These items they have given. Okay. Then they have given the significant judgment and estimate. Significant estimate and assumptions are required in particularly for what? You can see that they have given before accounting policy, they have given judgment and estimates. Useful life of property, plant and equipment and intangible asset. Impairment requires a lot of judgment where you need to estimate value in use and fair value less cost to sell. Taxes requires some significant judgments. Fair value measurement of financial instrument require a lot of judgment and estimate. Gratuity, leave encashment require a lot of judgment. Inventory measurement, where you need to estimate your net realizable value. What is net realizable value? It is not a market value. It is an estimated selling price minus estimated cost of completion minus estimated cost to sell. So again, it is an estimate. Lease term and discount rate, again, it's an estimate. Asset retirement obligation, it's an estimate. Recognition and measure of contingent liability, again, estimate. So you can see before accounting policy, they have given a lot of estimates. So this part was not there in accounting standard. This part is there in Ind AS, right? So there is a huge requirement. So there is a new requirement of disclosing the significant judgment and estimates in addition to the significant accounting policy, in addition to the material accounting policy. Is that clear, friends? Is that clear? I hope you guys able to understand with the help of this practical live example. Let me know if you have any doubt. Yeah. The company is also required to disclose the capital management policies. What is capital management policies? How the company is managing the capital, right? How the company is maximizing the shareholder wealth. If you read the Infosys annual report, you will find this says that our company is completely funded from the own funds. They have a very, either they don't have the debt or I think it's a very minimal amount of the debt, right? They always used to do either buyback or pay dividend, right? To maximize the shareholder wealth. So what is their capital management policies? They are also disclosing in the financial statement. So this is what it is required in the Ind AS financial statement in the notes to accounts, right? And friends, as I told you that for Ind AS financial statement division 2 to schedule 3 is the guidance which talks about the format of financial statement. Quickly, we will discuss the difference between the Ind AS compliant schedule 3 versus the old schedule 3, right? So friends, in our old schedule 3, what happened in our old schedule 3? Just give me a minute. Yes, in our old schedule 3, in IGAP, the balance sheet order is first liability, then assets from top to bottom. But now in Ind AS, it is asset to liability from top to bottom. So friends, in Ind AS, the line item like investment property, financial asset, financial liability, etc. is there. But in IGAP, no such line item were there. Cash and cash equivalent and other bank balances has to be shown as a separate heading on the face of the balance sheet in division 2 to schedule 3. But in division 1 in IGAP, the line item is cash and bank balances and breakup has to be shown in the notes to accounts. Other comprehensive income is required in Ind AS, new item, but no such requirement is there in IGAP. A statement of changes in equity is a separate component, but no such separate component in IGAP. The name is other equity in Ind AS. The name is reserves and surplus in IGAP. So this is what the major difference I just want to call out here. Comparison between IGAP and Ind AS so that you will have a better understanding, friends. Between Ind AS 1 and IAS 1, so we have a carve out in terms of long-term loan covenants, right? Where if after the reporting date, if after the reporting date, the company has made good the violation which the company has made on the reporting date, so it will be considered as an adjusting event. But such kind of, in Ind AS 1, it will be considered as an adjusting event. In IFRS, it is non-adjusting. Second, it is a removal of option. In IFRS, in IAS 1, the expenses in P&L can be classified either on the basis of nature of classification, nature-based classification, or on the basis of function-based classification, right? So, friends, in Ind AS, we have not taken both the option. We have only taken the nature-based classification of expenses, right? Is that clear? Coming to Ind AS versus AS. So in Ind AS, the guidance is Ind AS 1. In IGAP, it is AS 1. So see, a statement of changes in equity is required in Ind AS, but it is not required in IGAP as a separate segment, as a separate component. Although in the notes to accounts, it is required to be given. OCI, it is a new item. It is not there in IGAP. Extraordinary item is especially required in IGAP, but it is not required in Ind AS. A statement of compliance is required in Ind AS. It is not there in IGAP. Key source of uncertainty, judgment, and estimate, right? These items are required in Ind AS, but this judgment estimate is not required in IGAP to be given. Third balance sheet, in case of correction of an error, in case of a change in accounting policy, the entity is required to restate the comparative and give the third balance sheet, right? In IGAP, this third balance sheet and restatement of comparative is not required. The impact has to be calculated. The impact has to be calculated from the beginning, right? The impact has to be calculated, but the presentation has to be prospective. The impact calculation is retrospective, but the presentation has to be prospective, means in the current year. Impact needs to be taken from the last year, from the date of the error, or from the time where we are taking the impact of the change in policy. So impact calculation is retrospective, but the presentation is prospective. Application is prospective. But in Ind AS, even the impact calculation and the presentation or application is also retrospective. I hope this is clear to everyone, friends. I hope this is clear to everyone. Let me know if you have any doubt. So friends, quickly we will discuss some multiple choice question, right? So that to check your understanding, and then if you have any query, I'll discuss that, and then we'll conclude the session. So let me know if you have any query so far. Thank you, Pooja. Thank you for such a nice feedback. And I know that showing the annual report will always helpful, right? It will register in your mind how this thing is practically happening. Yes, guys. Now the question number 1. The objective of Ind AS 1 is to prescribe the basis for what? Basis. Ind AS 1 prescribe what? Disclosure of accounting policy, presentation and disclosure in general purpose financial statement, presentation of general purpose financial statement, disclosure in general purpose financial statement. I would recommend you, just before giving an answer, think about what is the name of this Ind AS 1? What is the title of Ind AS 1? Again, I am telling you, what is the title of Ind AS 1? This will give you the right answer. Friends, C is the right answer. Yes, presentation of general purpose financial statement. The title is presentation of financial statement, right? C is the right answer. Question number 2. Does complete set of financial statement as per Ind AS 1 includes notes to accounts? Yes, no, or entity choice? You are right. It includes. Yes. Right answer is A. A is the right answer. 2A is the right answer. Yes. Number 3. Name the two new component of set of financial statement under Ind AS framework. I know this everyone can tell. Yes. Other comprehensive income and statement of changes in equity. 3C. Ind AS 1 is not fully applicable to balance sheet, statement of P&L, statement of changes in equity, interim financial statement. Yes, D is the right answer. Friends, you remember as I told you, as far as key features are concerned, it is applicable to the interim financial statement. But as far as structure and content is concerned, it is not applicable. Ind AS 1 is not applicable to interim financial statement. D is the right answer. Question number 5. Ind AS 1 does not prescribe the accounting policies, does not prescribe the guideline for balance sheet, guideline for SOCI, guideline for P&L. Tell me what is the right answer. Tell me what is the right answer. You all are right. Ind AS 1 does not prescribe the accounting policy. Who prescribed the accounting policy? Ind AS 8 prescribed the accounting policy. 1 does not prescribe that. It only says that the notes to accounts should contain the accounting policy. Which one of the following is not required to be presented as a minimum information on the face of the balance sheet according to Ind AS 1? This I have already covered, right? Contingent liability, it is a off balance sheet item. Number 7. Which of the following is not a required disclosure of Ind AS 1? Friends, this question does not ask about Schedule 3. This question only talks about Ind AS 1 disclosure. So then answer it accordingly. Name of the reporting entity, whether it is required? Yes, it is required. Okay. Name of major or significant shareholder, is it required? In the financial statement, it is required, but not as per Ind AS, it's per Schedule 3. So I am talking about Ind AS 1. Level of rounding of it is required. Financial statement, individual or console, it is required. So what is the right answer? B is the right answer. This disclosure is not required as per Ind AS 1. This disclosure is required as per Schedule 3. So here the question talks about Ind AS, right? Which of the following report is not a component of the financial statement according to Ind AS 1? I know that everyone will be able to give the right answer. Balance sheet is a component, statement of changes in equity is a component, notes are the component, director's report is not the component. Yes. Last question. I will conclude the session in the next 2 minutes. So I would request, if you have any query, please write down your query on the query link of ICAI. I will be answering that the answer of that query. So friends, before that, what is the right answer of question number 9? An entity whose financial statement comply with Ind AS shall make an statement of such compliance in the notes to accounts. Explicit and reserved, implicit and unreserved, explicit and unreserved, implicit and reserved. You remember para 16? You remember that statement, true and fair view in compliance with all Ind AS? This is explicit and unreserved. You all are right. Explicit and unreserved statement of compliance, right? Explicit and unreserved statement of compliance with all Ind AS. With all Ind AS. Okay, friends. So, friends, thank you so much. I have completed this Ind AS 1 in detail. This is a very fundamental standard. I would request each one of you that please go with the study material. Do all the questions of the study material, right? This is the main fundamental. If you are well understood these concepts, you will be able to solve all the problems of the study material, right? You will be able to, understand when you will revise those concepts. Let me know if you have any query. Otherwise, I will be concluding the session today. And thank you, friends, for such a wonderful feedback. And I'm really glad that you have liked the session, you have enjoyed the session. So today we have completed Ind AS 1. We have, started with the key consideration or key features of the financial statement, where we talked about the true and fair view in compliance with all Ind AS, going concern, your materiality and offsetting, your consistency, aggregation, accrual basis, your comparative information, So we have discussed all those concepts in detail. Then we talked about the structure and content, where we talk about the balance sheet, statement of profit and loss, other comprehensive income, statement of changes in equity, cash flow statement is referred by Ind AS 7, which we'll discuss tomorrow, and notes to accounts, right? We talked about the estimate and judgment. I have shown you 2, 3 annual reports, right? So we discussed the current and non-current concepts, right? So thank you so much, students. Stay safe, stay happy, and we'll meet tomorrow as well. Thank you. Bye bye. Take care. Yes, it's over.